Hello and welcome to Triage, timely conversations for healthcare professionals, a podcast created and produced by K&L Gates. Each episode is designed to highlight important developments in health law and analyze the impact on our clients and friends of the firm. We hope you enjoy this podcast.
Welcome to this episode of Triage. My name's Josh Skora. I'm a healthcare regulatory partner in our Dallas office. I represent healthcare companies and providers across the country with their regulatory and transactional needs. Today, on the last day of the first quarter of 2021, I have the privilege of interviewing two of my colleagues, Rick Giovannelli and Ken Marlow, about the M&A landscape during and after COVID-19 and 1 year since it really started. Rick is a corporate partner in our Charlotte office and regularly advises companies and private equity firms in the healthcare transactions. He's also a practice area leader of our corporate group and services and serves on K&L Gates Management Committee. Ken's a healthcare transactions partner in our Nashville office and regularly advises health systems and other healthcare companies on mergers, acquisitions, and joint ventures throughout the country. Ken has worked on more than 50 acute care hospital transactions with an aggregate value of over $16 billion. Thank you both for joining us today. I'm really looking forward to this. The first question I have for both of you is, in general, what concerns are you hearing from clients regarding the effect of COVID-19 on the healthcare deal environment moving forward and now?
Yeah, I think that, one of the challenges that we see is that I think that a number of the companies have felt the significant blow over the past year and the challenges that they faced, and we're hopeful that they would be out of some of the difficult times and continue to, of course, face a lot of the operational challenges that really haven't relented yet. And so, while I think that there's been an effort to get to a place where they could start sort of getting back to their strategic focus that they had pre-COVID, I think that there's still quite a bit of time and effort that's spent on the operational challenges. And so I think as they are starting to look at this year, I think that while there are certainly aspirations of growth and consolidation and trying to position themselves best for the future, I think that there's still some of the practicalities of COVID that have impacted them. And so when you look at, for example, the liquidity crunch that they faced, when you look at the cancellation of procedures, the increase in expenses and just all of the additional stresses on, in particular, hospitals and health systems, but also in some of the, ancillary services such as the ASCs, there's been a significant amount of challenge. And I think that's had a long-lasting effect. And so while I think that they're still trying to use this environment, one that does have opportunities, I think that there's still some of the impact of, what we've seen historically over the last year.
Yeah, Ken, I think that's exactly right. I think that one of the challenges is your management team's distracted, they're cash constrained. In addition to not having the revenue coming in, there's a bunch of CapEx that they have to put out to adjust their facilities the way that everybody has to adjust their facilities right now. And the other challenge that we see is just pricing right now. Right, if you're pricing off a trailing 12-month EBITDA, how do you look at that when procedures were so far down and a lot of the revenue that actually came in last year was either COVID related or government stimulus related? And so what we've seen is a gap between buyer and seller expectations in many cases, where sellers want to trade off of some assumed growth rate and buyers are looking at the numbers and saying, well, gosh, look, your numbers were terrible. You talk about an ASC, Ken. Nobody went to an ASC from April through probably August. And so how do you come up with a revenue model for that business, particularly if it was growing very fast? Are they continuing that growth or did they plateau? Would they have plateaued but for COVID? So that's the challenge that we see. And as Ken said perfectly, as we exit COVID and return more and more to whatever normal is going to be, buyers and sellers will both have more of a financial track record that they're going to feel comfortable trading the business on. So that's one of the key challenges that we're seeing right now.
So piggybacking off of that, I have a quick follow-up question. Are you seeing any of the inverse happen where companies did very well over the last year, but buyers are trying to discount that?
Yeah, Josh, it's a great question. What I've said to a couple people and what I'm hearing from investment bankers and others is that The businesses that tended to trade were what I would say are COVID agnostic, where you could look at them and say, okay, COVID didn't really drive them up. COVID didn't really drive them down. So we have a pretty clear picture of what they are. The problem with businesses that got a huge boost from COVID, and telehealth companies are a great example of that, right? Is that demand real? Is it a temporary shift, or did it simply, as Scott Galloway likes to say, COVID simply accelerated changes that were already in the marketplace and were going to happen anyway? And is that acceleration a repeatable revenue stream that a buyer can now pay for? And we're seeing gaps in the other direction for buyers and sellers there. Buyers are saying, well, yeah, look, you had a great 6 months, but I can't pay a full price on that because I don't know if that's sustainable. And sellers are saying, well, of course it's sustainable. You got to pay me for it, right? So you've got the gap on both ends. And that's why the middle swath, I think, is where you're seeing more M&A. Ken, I don't know if you've had a different experience.
No, I would actually say that it was very similar in that we are certainly seeing a number of companies that are looking to go to market that have certainly seen a boost as a result of the particular business that they're in. I think of urgent care, I think of the digital health companies that are expecting pretty significant multiples that are aspirational in many cases, assuming that this trajectory that they've been on will continue and that they will essentially increase that business by multiples and are wanting the purchasers to essentially pay a multiple off of that. And so one of the things that we've seen a lot of recently is discussions around earnouts. And if you can structure those in a way from a regulatory perspective, and also sort of that gives the sellers the ability to have potential for some of the upswing that could occur as a result of future profits and that's continuing on that trajectory, but at the same time protect the buyer from the standpoint of, say, this does level out in some cases, and you don't want to be in a position where you've paid well in excess of what the value really should have been if you had had the benefit of hindsight.
Yeah, Ken, that's a great point. That's the earnout point is a great point. We're seeing so many of those. I think every LOI we've got on our desk right now either has a placeholder in there for it, or we're in the throes of hashing out what that might look like precisely to protect against the risk that you mentioned. That's a really, really insightful point there.
So Ken, you primarily represent health systems and other providers and transactions, but you do a lot of joint venture work in that space. On the health system side, how has COVID affected joint ventures? And maybe talk about lack of resources, or if there's more appetite for that to try to gain some revenue back.
Yeah, I think it's a great question. And I think, some of this is consistent with, what we've talked about before in terms of the challenges that a lot of these health systems have faced, particularly with respect to acute care hospitals, back to the liquidity crunch and the, cessation of elective procedures. All of these mounting, headwinds have been a challenge for these health systems. And so what I think that you've seen is that it has forced some of those that have historically been operating on razor thin margins and now are sliding more into the red to say, now is the time that I don't really have a choice, but I have to partner. And so even some of those that might be competitors within very, small markets are seeing that, perhaps, for my own viability, it's best for me to partner with another system. And so we've actually seen a lot more activity in terms of particularly service line JVs, where that can enhance the services that are provided from one health system to another. Also, certain ancillary lines, I would say, I think of some of the behavioral health, in some cases, digital health. And so there are sort of these add-on ancillaries that can be helpful to a system without having to make the full investments that they would, say, in a complete, fully integrated consolidation between two systems. And so I think as we look to this year in particular, I think we're going to see even more activity in terms of, we've got a number of systems that are looking at their portfolio optimization. And so figuring out, how do I best find a way to focus on the strengths that I have certainly takes less stress off of the areas where perhaps I'm not in the best position to be the operator for those services, and looking at partners for potential joint ventures for those service lines.
That's really interesting. Thanks. So, Rick, on the flip side of that, you represent a lot of private equity companies, and many of them focus on healthcare. So, 2020 started with an incredible amount of dry powder in the PE space. And it looks like that may have continued and is picking back up now. So, what's your sense of how PE firms navigated COVID last year? And has anything changed towards the end of the first quarter of this year?
Yeah, look, I think that there's still a lot of dry powder out there, in part because they weren't able to put a lot of that capital to work on new deals in the first half of the year last year. Last year for private equity was primarily a year of focusing on their portfolio. Ken, you mentioned portfolio optimization for the hospital systems. The private equity folks were having to do exactly the same thing. And they were struggling with, as a fund, do we want to participate in the various government stimulus programs that were out there? And we all remember the whipsawing that you saw on the PPP program, where at first it looked like just the greatest thing ever. And then Shake Shack and others went and got greedy and created this huge negative perception on it. And at that point, we spent as much time talking with private equity funds about, hey, should we let companies in our portfolio take a PPP loan? When obviously it's a great program for those types of businesses. Again, the service provider, they're shut down. They're not providing any services. For a normal company that's private equity backed, they're going to lay off their workforce in that situation. The PPP comes along and provides a perfect antidote to that. So what you saw was the funds debating whether to take the PPP loan. A lot of them ultimately decided not to. They did participate in the provider relief funds and the other tax incentives that were out there, but you didn't see a lot of deal work. And then as we started to turn the corner toward the end of the year, obviously deal flow went off the charts. And as we ended 2020, rolling into 2021, things were just incredibly busy and deals were starting to get done. People had figured out, okay, we now have a baseline, putting aside some of the pricing questions for at least that middle swath of agnostic businesses, we can come up with a price. And there was a ton of pent-up demand. I've just seen some statistics recently that the third quarter for deal flow in 2020 was the second largest ever. And the fourth quarter was the largest ever, particularly in the middle market where a lot of private equity players play. So I think you're right, Josh, that there is still pent-up demand out there. There are a lot of acquisitions that will be happening. We saw everybody sort of pause, catch their breath, figure out how to get through the crisis. Now, even though we're still not out of the woods, the private equity funds, the platforms, the roll-ups are really starting to get back into the business of buying up some of the small practices. And you had asked, what we're seeing is that in some of those situations, they have to look at buying companies that took a PPP loan. And that's putting a little bit of pause on it. Do they want to do that? Fortunately, SBA has given us some guidance on that, but we seem to have gotten over that hurdle. And now I think that as we move into second and third quarters of 2021, I think private equity will be very active in the space.
So, quick follow up on the PPP. I know you've talked extensively about this. So, now is it pretty much all deals that are buying PPE loans? Are they just putting it all in escrow, or are there other unique ways to deal with that at closing now?
Yeah, the SBA gave us guidance that basically said as long as the borrower has applied for forgiveness, you just put the money in escrow with the lender and you let it sit until you get a forgiveness decision. If it's forgiven, it goes to the seller. If it's not forgiven, it goes to pay off the lender. So it's pretty simple. And that's frankly where the market had kind of settled out before that anyway, right? You still do get into some questions now because, and especially now the PPP has just been extended for another 2 months through the end of May, a lot of banks aren't able or willing to process applications at the same time they're processing forgiveness applications, right? New loan applications. So what we're seeing is that a lot of the forgiveness portals are shut down, but the new loans are still coming out. So when this originally happened, we thought the M&A aspect for a PPP borrower, that was going to be really an early 2020 phenomenon and would be certainly burned off by the end of the year. Now, with a 24-week forgiveness period, you're going to be looking at borrowers that aren't going to be finished with their forgiveness period until very close to the end of 2021. And so what some of those borrowers are being forced to decide is, I can't comply with the SBA safe harbor because I haven't applied for forgiveness, either because the bank's not open or I'm just not even close to being through with the money yet. So in those cases, they're having to make a decision. Do they try to get SBA consent? SBA is not responding. Or do they just pay the loan off? And that then it becomes a question of how big is the loan relative to the size of the deal. If you've got a $100,000 loan on a $20 million deal, it's pretty easy to just pay it off. If you've got a $10 million loan on a $15 million deal, then you've got a much bigger issue. And the seller's not going to pay that off. So you're going to have to figure out some workaround. And the best workaround is probably at this point to wait, unfortunately, because there's just not a way, it seems, to get clearance through the SBA.
Waiting is not always our client's strong suit.
No, never. They don't like to hear that.
So, Ken, I wanted to turn back to you because we have got a change in the White House now, and it's been a couple of months. What are you seeing, and do you think that the change in politics in the White House is going to have any effect on the M&A market?
So I think that there are some immediate takeaways. I think one of which really gets back to the ACA. As you know, we've seen the challenges to the ACA that were in front of the Supreme Court. And I think that based upon, some of the questions from the justices, it certainly appears pretty clear that even if the mandate isn't found unconstitutional, I think it will be severed from the ACA. And so from that standpoint, I do think that we will see a reinforcement of the ACA, which I think for the healthcare industry overall will be a positive impact. I think that, there's also the issue that I think we're going to see a number of individuals that are coming back into ACA coverage. And so I believe that, we're already seeing those numbers increase significantly, I think, which does help the overall healthcare environment. That being said, I do think that there are some really difficult challenges ahead. Some of those come in the form of antitrust. In particular, we know that the health plan that was set forth by the Biden administration specifically mentioned that they were going to be focusing very carefully on the consolidation of the healthcare industry. We also know that Vice President Kamala Harris has a track record from her stint as the Attorney General of California, reviewing very carefully transactions in the healthcare space. So I do think that as we look at, consolidation within the healthcare industry in particular, that there's going to be more regulatory scrutiny for those M&A transactions. And we also, know that recently there was also an oversight subcommittee hearing that was related to private equity's expanded role in the U.S. healthcare system. And so from that standpoint, we already know that that's also another area where there is an effort to really scrutinize healthcare private equity in particular and its impact on the provision of healthcare services. And it's interesting because just in looking at, some of the takeaways from that hearing, it's clear that there is some underlying current that would suggest that there are members who think that for-profit private equity is more intent on seeing maximization of profit and less concern regarding the quality of those healthcare services, which I think is a debatable issue. But from that standpoint, I do think it's yet another area where healthcare transactions are going to see more scrutiny. And so I think that there's sort of both positive and negative in what we will see from the Biden administration. I'll echo a lot of what Rick has already indicated, which that I think part of this is really about the market itself. And I think there's tremendous demand. There's been pent-up demand with lots of capital that's ready to be deployed and really looking for strong assets to invest in. And so while there may be some of these challenges, particularly when you're looking at, for example, last year was one of the largest years in terms of the mega mergers, those mergers in the healthcare space where the seller had over $1 billion in revenues. And so I think particularly with the consolidation in those mega mergers, I think we're going to see a lot of scrutiny there. And I wouldn't be surprised if we see some attempts at legislation in terms of creating more processes, procedures around the review of some of those transactions. So, all in all, I think it's favorable, but I do think that there will be some challenges along the way.
So, Rick, I don't know if you have anything to add to that, but when I read the coverage on the subcommittee hearing, it seems like a lot of their most pointed questions focused on private equity and long-term care space. So I'm not sure, Rick, if you're hearing anything from your clients or in the market as to how people are perceiving that, or just the general political swings in general.
Look, I think the private equity industry is glad that Elizabeth Warren was not named the Secretary of Treasury. So I think anything else they get from this administration will probably be a little bit of a win for them. But no, they're very concerned about that. And then an ancillary to that is at the same time that hearing was going on, you had the hearing on SPACs yesterday, right? So it seems like they're coming at the DC is coming at every deal structure and trying to get their arms around it. I'm not sure that DC has really ever fully understood what the private equity industry is. I think, Ken, your point is well taken that they seem to view private equity as an engine only for evil profit taking rather than a source of job creation and innovation, which I think is what a lot of our clients would tell you how they see private equity participating in the market. And again, as Ken said, that's debatable as well. But I think there's a little bit of nuance and a little bit of truth to both. But they certainly are worried about what we're hearing out of DC. And in some ways, you may actually see that accelerate deal flow if it looks like some adverse changes are going to be coming down the pipe. It's harder to apply those retroactively than it is to make new deals harder going forward. So depending on the types of reforms, if any, that seem to be coming, it may be that you see deals accelerating to try to get done under the wire so that they are not affected by whatever changes might be imposed on deal structures. Now, obviously, to the extent that the changes apply to ongoing ownership, then it would be harder to do that. But to the extent it's transactional based, I think you might see it actually accelerate deal flow a little bit.
Yeah, it's interesting to me too, if you just look at some of the comments related to that hearing. A lot of it was focused around transparency and giving more visibility into ownership and things of that nature, less so from the standpoint of increasing additional restrictions. So it'll be interesting to see how this evolves because, to your point, Josh, I think that it does seem very calculated and specific to nursing homes in particular, and that they have sort of a laser focus on this, which is a little bit surprising to me, which is a little bit reminiscent of what we saw in, for example, Miami-Dade County and the home health agency, about a decade ago, where there was sort of rampant fraud there. And so there became this effort to really focus in on home health and really sort of expose any issues of fraud that they could find. And so it'll be interesting to me to just see how this evolves, and does it become anything bigger, or is it primarily tied to some of these issues around the nursing home area?
Yeah, it's interesting, Ken. Obviously, the nursing home and long-term care area, I mean, you couldn't go a week without hearing some pretty negative stories about that industry because of some of the COVID statistics that we saw coming out. I don't know whether there's a correlation there. There's probably a correlation. I don't know whether there's a causation there, but I wouldn't be surprised if there were. And I think that that's where some of the concerns around the level of care come out because of some of the things that we saw in the news coming out of that. And on the transparency point, that's an ongoing pendulum between the industry and the regulators. And there's an ongoing debate as to whether you can simply disclose through transparency your way out of things like conflicts of interest and other things like that. And the SEC has said at various times, no, you can't. That just because you've disclosed something doesn't mean it's okay. And the industry would much rather obviously take the more free market approach, which is, look, as long as all the parties understand what they're signing up for, these are all sophisticated investors. We ought to be able to structure our funds and our deals however they want. That's all fine when it comes to aggregating capital. But when you talk about deploying capital into the healthcare industry, right, that's when the patient care, as you said, Ken, becomes the foremost concern and can be a lever into a way to really regulate the transactions, get more transparency around a lot of pieces of the transaction. So it'll be interesting to see how those two levers play out.
That's a good segue into the next question I had for you. Because as we all know, before COVID, private equity spent a lot of time rolling up physician practice groups, dental clinics, management companies, and those companies were by far the hardest hit during COVID.
Sure.
So as we're now coming out the other end, what tailwinds or headwinds are you seeing if you were to look around the corner for the rest of this year? If there are any different verticals that you think might get hurt more or benefit?
I think that vertical is going to come back strong again once you start to see what the new normal looks like. A lot of those companies, again, didn't have organic revenue. They had stimulus revenue in one form or another last year. Some of them are not going to recover as strongly, and you will see some distressed M&A in that space. Others, there's going to be a ton of pent-up demand, and you will see a lot of business going into that. And again, that's going to be the question. That's going to be, is this pent-up demand sustainable, or am I just really paying for 2 years of service that end up getting provided in the first 6 months of 2021? That's where we have to see. And so my crystal ball is a little hazy on that. I do think some of the sectors that Ken mentioned earlier, I think digital health is absolutely here to stay. I think, again, going back to the Galloway comments, that COVID was an acceleration, not a fundamental change agent, that digital health was coming one way or another. We're all sitting here looking at each other through a screen right now. We've gotten used to doing that with our doctors as well. I think that's only going to stay. So companies that play in that space, that adjacency space, I think you're going to see a lot of demand there, because that is a long-term shift in the medical practice. And then that also has impact in the ancillary space of medical office space, just like we're seeing in commercial real estate across the board. Our practice is going to need as much space as they've taken in the past. I think that the smart money tends to be shorting that in the long run. So I think you might see less activity in that space. And on the provider side, I think it's too early to tell. Ken, you may have a better visibility into that than I do.
Yeah, I would say that certainly as you look at the continuum of care, I think we've seen historically there's a push to move procedures from the sort of hospital acute care setting and push those down to other ancillaries, or in particular also out to the home. And as part of that, I think that the regulations, reimbursement really did not perpetuate what was required in terms of being able to move those things forward. And so what I do think that we will find is that there will be a shift, particularly with respect to digital health, behavioral health, these other areas, the ASCs that I think will be winners in this. I think acute care hospitals will have a very difficult time, because I think that the movement is away from the acute care hospital into these ancillary areas. And I think COVID has made that crystal clear for everyone that you can get those services digitally as well.
We've got time for one more question. And Ken, I wanted to follow up with that to talk specifically about kind of distressed assets and distressed M&A, and maybe also distressed real estate, where we haven't seen much of that yet over the last year. And I'm not sure if that's another shoe that's going to drop, but I'm interested in your take. And then also, Rick, your take on that during COVID and after COVID.
Yeah, it's certainly interesting, because I think this is a question that we have had for year after year after year in terms of distressed health systems in particular. You know, as I alluded to earlier, I think a lot of them have been operating on razor thin margins. And, you know, what's really happened is that the government funding has buoyed them in a way that they are still in a survivable position. And I think that while one would think that the inevitable will hit, which is that, you know, when the funding subsides and they're sort of forced to stand on their operations, we know that the inpatient volumes have certainly decreased over time, and think that that will continue as these other providers in ASC and other spaces take on some of those procedures, that we're going to see that continue to have a hit. The question will be, I think, in part, whether or not those systems will be smart enough to find a partner and do that in sufficient time, because we have seen, over the last year, some increased distressed assets, that have, ultimately just had to close their doors because they did not have a partner at the time. And so I think that we will continue to see this. I don't think that it will be an avalanche of distressed assets that are, within, say, the next year. But I do think that we will see certainly an increase in the number of distressed assets. And I think we'll see more activity as a result of that. I don't know, Rick, if you have, additional thoughts on that.
I think you said it exactly right. Look, private equity buyers in particular are opportunistic, and they will be looking for distressed assets that they can pick up on the cheap. The problem is, and you talked about the razor thin margins, right? The government funding has done nothing to fix that. It's only kicked the can down the road, right? And so those companies that were already trending negatively or very thin margins, it's very unclear that once that funding stops, once the spigot is turned off, it's not clear what will be left there to buy on many of those. So Ken, I think you said it perfectly. There may not be a wave of distressed M&A. There may just be simply a wave of these businesses simply shutting down and liquidating. But I do suspect that there will be more distressed M&A in the second half of this year as we start to get clarity on what those numbers actually look like when the government funding is not available. And that's what the buyers need in order to transact on some of those distressed businesses.
Well, Ken and Rick, this was a real treat for me. I really thank you all for joining me for the last half hour or so. And I'm sure those who listen will also learn as much as I did. So thank you.
Thank you, Josh. Thank you, Ken. Good to talk to you.
Thanks.
Thanks again for listening to Triage, timely conversations for healthcare professionals. New episodes are available for download through Apple Podcasts, Google Podcasts, and Spotify. By subscribing to Triage, you will receive timely notifications for each new episode. Also, if you have any topics you would like to hear discussed on Triage, please don't hesitate to email triagesupport@klgates.com. We would love to hear from you.